Elon Musk turned scarcity into a weapon, and now investors are begging to buy stock in a company that comes with no exit. For years, getting into SpaceX meant visiting headquarters, sitting through interviews with Musk's CFO, and waiting for personal approval from Musk himself. One investor needed a connection with Musk's cousin to buy $10 million of stock. A portfolio manager at a $500 billion fund had to use his Tesla board relationship just to get an allocation. The harder Musk made it to invest, the more investors wanted in. Then SpaceX went public, and the frenzy exploded. The IPO drew $350 billion in demand for $75 billion of stock. Shares jumped 19% on day one, pushing the company past $2 trillion in value. But here's what investors are ignoring: SpaceX lost nearly $5 billion last year. Musk controls 85% of voting power through dual-class shares, meaning he answers to no one. Public shareholders can't remove directors, block deals, or influence strategy. Denmark's largest pension fund blacklisted the company, calling its governance catastrophic. Yet retail investors poured in anyway. SpaceX became the most bought stock the day it debuted, beating even Nvidia. Scarcity doesn't just create demand. It erases questions. Meta has begun dismantling its $2 billion acquisition of Manus following a directive from Beijing demanding the deal be reversed. The unwinding represents one of the largest tech M&A reversals driven by Chinese regulatory intervention. The acquisition, which was valued at $2 billion, is now being systematically undone as Meta complies with Beijing's order. This marks a significant assertion of Chinese regulatory power over global tech transactions, forcing a major U.S. company to reverse a multi-billion-dollar deal. The episode underscores the growing willingness of Beijing to intervene in cross-border tech acquisitions and signals heightened geopolitical friction in the technology sector.